Fine. So if you remember last week, we completed our discussion on several things. We in this module, our module was to understand about the interest rate, if you remember. And then within this, we talked about various determinants, why interest rate movement we observe. Then we talk about forward rate, if you remember, forward versus spot rate. And then we talked about term structure. Term structure we have discussed. And after that, we discuss about why interest rate is important. Where we talked about opportunity cost, if you remember, we talked about basic return, we talked about expectation. So all these things we talked about. And after that, we started our discussion on application of interest rate. And within that, we were discussing about time value of money. And in time value of money, if you remember, we discuss about two concepts. One concept about future value and present value. And where we are going to use, and within future value, if you remember, two different type of concept we can think of. Future value of lump sum amount. And here you have regular amount, or you can call annuity. And same way in when we talk about present value concept, same way you will have lump sum amount and then you have annuity. And lump sum amount basically single time amount. For example, if you want to know what would be the value if you deposit in a bank today, let's say this is your T is equal to 0 at certain time period. So here you deposit certain amount at a given rate. So given rate basically, let's say this is R and this rate is your nominal, including your inflation rate. And in future, you want to know how much this amount will be in nth time period. Basically, we are talking about future value or concept related to future value. Whereas another type of example we can think of where you are expecting to get certain amount in future. And assuming that we are standing at this point of time, T is equal to 0, you want to know what is the value of this amount today at given rate. This rate is of today, because whenever you are valuing any amount, future amount, today you are referring to today's interest rate. So that's why in this case, basically what you want to know the present value of this at here. Present value, when we are saying it is at your reference point or your reference time period. And that's why you're here in present value you will be discounting. So in this case, let's say this is nth time period, so you are going to calculate present value of this amount, assuming this is your A. So A divided by 1 plus prevailing interest rate to the power n. It means inverse relationship. So basically here PV is inversely relationship to interest rate and time period as well. So that's why we expect this kind of as a value of interest rate or your expected value when it is going to increase. Then in that case, what will happen? Your present value will come down. It depends upon your interest rate and number of year. And also, if your number of year is going to increase, you will have higher slope for your present value. So same way here, it is just opposite. If you are investing certain value today, it is going to be compounded for n time period. It means there is a direct relationship, so you will have upward slope with interest rate. So this is what already we have discussed. Now here is one example. This is example of annuity. So what is annuity? Annuity is basically amount received or paid. So it is a kind of cash flow you can thought of at fixed time interval. Fixed time interval. For example, every year, if you are depositing certain amount, and that amount is fixed up to given time period, it could be n or it could be infinite based on how we consider our case. So in this case, that amount that you are depositing at the end of every year, that is nothing but annuity at the end of every year. So in general, within the annuity, we have two concepts, annuity and annuity due. Annuity due. So basically annuity, when we say there is this payment received or paid at the end of time period, end of period. Whereas in case of annuity due, all these payments are at the beginning of the period. Beginning of period. So only this difference between annuity and annuity due is there. Otherwise, all the definition is same. So we will take this example to understand the present value of annuity due. So here you can see that at the end of every year, certain amount is expected. And we want to know if up to 6 time period or 6 year, this kind of payment is expected, then what would be the value of all these 10,000? So basically, if you recollect, this should be discounted for 1 year. This should be discounted for 2 years. This should be for 3 years. So if you want to calculate the present value of this annuity, that is going to be 1000K 1 plus R plus 1000K 1 plus R square. And then last term is 1000K 1 plus R to the power 6. And using your GP series, we can, if we can, go for nth period. So this way we can resolve it. We can, get one expression. So this is how we can calculate present value of certain amount. And same way, future value you can thought of, let's say every year you are depositing up to 10th time period. What would be, so if you solve this, this will be amount 1 minus 1 plus R to the power minus T divided by R. So this is, we call it present value of annuity. Means you are calculating at t is equal to 0 time period. Same way, when we are calculating future value of annuity, this is going to be compounded rather than discounting. This is going to be compounded for these many years. So when we calculate future value of annuity, it will be your amount, and here you will have 1 plus R to the power n minus 1 upon R. So if you generalize it, and here this could be T or N, up to you. So this is how we can easily calculate present value of annuity or future value of annuity. So here this is future value, so we can write already we have seen 1 plus r to the power t minus 1 upon r. So already most of you, those who have done certain courses in finance or accounting, they must be aware of all these concepts. And now many times, especially when we talk about banks, in bank every quarter compounding happens 4 times in a year. So it may be the case, let's say bank is saying that annual interest rate you will get on your deposit at 7%, but it is going to be compounded. So even for 1 year, this is going to be 7% is going to be compounded 4 times. It means if you want to know what effective interest rate you will be getting on your deposit, it should be addressed. It should consider number of compounding in that year. So that interest rate, which you are going to calculate on based on number of compounding in a year, that interest rate we call it equivalent annual rate or effective interest rate or effective annual rate. So this is how we calculate it and how we do that. So basically, if your formula, if you see, if your nominal interest rate is, let's say, R, assuming that compounding is n times. So in a year, or let's say compounding is rather than this, we write compounding is happening m times. So if I want to know that if let's say you are depositing your certain amount at R nominal rate, annual rate, this, and it is getting compounded m times in a given year. So in that case, your effective annual rate is going to be 1 plus r by m, because we need to divide it, because otherwise what will happen, it will assume that within a year your 7 or r% is going to be compounded, but that is not the case. R is annual interest rate, which is in nominal term. So it should be first adjusted for number of compounding frequency. So m is compounding frequency, and here it is going to be compounded for m times, and then minus 1. Why minus 1? Because your 1 plus when we calculate 1 plus EAR is equal to 1 plus r by m upon m, this way. So if you want to calculate EAR, it should be adjusted here. So this is the formula to calculate EAR. And here you see a particular case. We want to calculate EAR on 16%. Means annual nominal interest rate is 16%, and it is compounded twice. So this will become 16 by 2. So basically 8%, 0.08. Compounding is happening. M in this case is 2 minus 1. So of course, when it is reported that your interest rates is 16%, but because of compounding characteristic, 64 basis point additional return you will get. So that difference is coming only because of compounding. And now let's say this is if 8% interest rate is there, let's say bank is offering you 8% interest on your deposit, and compounding is happening quarterly, means in a year 4 times compounding will happen. So your effective interest rate will be 1 plus 8% by 4. So basically your 2%, and it is getting compounded 4 times in a year. And when we adjust, so your 8% basically effectively is 8.24% you get on your interest, your amount, deposited amount. And the reason is very clear, because every single rupee is going to give you 24 basis point additional And that is why additional, because of compounding characteristic, how bank is compounding interest rate every year. This part is clear. This is very easy. You can relate it. And some questions are there, so you can try it out after this class. And then if you have any doubt regarding all these questions, we can discuss it. So is there any question? Otherwise, I'll start valuation. Yeah, students. Fine. So I'll start another topic, which is valuation, because now what we are doing, we have understood all the concept, majority of the concept related to interest rate. Now we are going to see how interest rate can be used to evaluate or to value bond and equity. These are basically financial instrument available in the market. So now our focus here is to understand the application. And at the same time, we are going to understand characteristic of various instruments. Now, many of you might be aware difference between bond and equity. So what basically we are saying, when we talk about equity and we look at the characteristic of equity, basically when you purchase a share of a company's equity, or we call it share, or we call it stock, what it is representing, remember, it is representing your ownership. Ownership on firm's asset. Firm's, because when company is issuing equity, what company is saying? Company is saying we need capital, and the company's assets are basically, it is not explicitly stated, but what is said, because you are going to get ownership, so you will get appropriate ownership of firm's asset, so you become a partner. So this is one of the characteristics. Whenever you purchase a share, so in terms of ownership, you will be called as shareholder, or owner of that company. And then when you are owner, and many times company pay dividend, especially in this case, company may pay dividend or may not pay dividend. So it means there is because there is no liability when you are owner of a company. So considering the various company acts and guidelines, there is no compulsion on company to pay dividend to their shareholder at every time period or every year. It means, so chances are very likely that you may get or may not get dividend. Otherwise, if company is paying dividend, you will get dividend as a return, regular income from your investment. But there is no guarantee that you will get dividend at every year. Again, it depends upon company's policy, but chances are high that company may pay or may not pay you dividend. Now, when it comes to risk, because it is up to the manager. If manager thinks that company should make certain kind of payment to their existing shareholder, then only payment will be made. And in case of bankruptcy, you must have heard about what happened to Kingfisher, what happened to companies those were forced to liquidate, or those companies gone for bankruptcy. So in that case, the highest risk is for the equity holder or shareholder, and that's why because they are not going to enjoy a dividend every year, and they are owners, so they are liable for obligations, firms obligations as well, and that's why they bear high risk. But at the same time, they get voting right, and finally, we call these shares or stock as equity instruments. So basically, these are the characteristics of share or equity instrument or share or stock, whatever we want to call. Now let's compare with the bond. Remember, bond, when we call, basically this is your debt instrument, means like similar to bank loan. And if you remember, when you take bank loan, you will have to pay interest. You will have to pay principal amount. Your principal amount. And then you will have certain kind of obligations or contract or agreement. So whenever basically this is a debt instrument, so there will be interest payment, and because of interest to be paid by the company to the bond holder, it means as a bond holder you will get certain coupon, or sometimes we also call interest. It means if you are purchasing bond, remember in case of equity, you are going to be shareholder, but dividend, if dividend is paid, you will enjoy regular cash inflow from your investment. Whereas in case of bond, company will have to make payment of coupon or interest rate on regular basis, and also initial principal amount company will be liable to pay. So that's why this is fixed obligation. So this is interest is basically fixed obligation, and there is a guarantee, means this is a debt instrument, means company is liable to pay. And if company, and this makes company also so many times attach their collateral or asset whenever this kind of instruments are issued. And that's why these agreements are basically obligatory for the company. If company is not able to meet their obligation towards regular interest payment or coupon payment, in that case your bond holder may take some kind of strict action against the company. So that kind of contract or agreement can be there. So it means they can have a kind of monitoring within the company. And now, bond holders are basically, lenders. So, and lenders don't get voting right, but based on the type of contract, they may have, what we call some kind of, contractual condition they can superimpose on the company. And in terms of risk is low, because as per the guideline, whenever company is going to be liquidated, first these bank and debt provider or creditor get preference. So when in case of bankruptcy, if you see who will get first, so your creditors means your debt capital provider, your bondholder, bank, they get priority. After that, preference shareholder, they get priority, and at the last, equity holder or common shareholder. And that's why in terms of risk, bondholder bear less risk. And so as it is mentioned that benefit, they get regular income, and generally you will find over the counter, and now bonds are also traded on exchanges. So we will see, one example so that it is going to be clear. So these are basically the characteristics of share and bond. And because of these characteristics, when we are going to value all these assets, these characteristics are going to be, important to remember. And now, when we, differentiate between preference share and common share. In preference share, they get, we call it preference share because they get priority, as we have, seen in our previous slide. In case of liquidation, preference shareholder get priority over a common shareholder, but they don't get, voting right. Whereas in case of common share, they get voting right. In case of preference share, here basically your preference stock or preference shareholder, this is a kind of hybrid instrument. If you have studied your corporate finance or some type of courses, you will find that preference shares are, or preference stocks are, hybrid instrument. Why hybrid instrument? Why hybrid? Because these instruments are basically having characteristic of both equity and debt. Why debt? Because whenever company is issuing preference share, shareholder will get preference dividend, stated preference dividend on regular basis, and that is the one of the characteristic that makes preference share or preference stock similar to your instrument, your debt instrument. And also because preference shareholders are many times convertible, so some kind of options are attached to convert into equity. So that's why they having some kind of characteristic of equity as well. And of course, they won't get any voting right. So and many times you will observe that company is not able to make payment to the preferred stockholder. But what happens? Company will have to pay. So company can defer for 1 or 2 years, but after in third period or so, when company's performance are good, preferred shareholder will get preference dividend, even previous due preference dividend. And that's why, so if we look at this characteristic, which is similar to equity. Why? Because there is no very forced obligation on the company to make payment to preferred preference stockholder, but company will have to pay when company's situation is better. Now, this is one of the traded bond issued by SBI India. You can see. So I have taken this on September 17, 2020 from NSE website. So why I am showing this? So that whenever you are going to evaluate or you are going to do valuation for bond, you will be able to understand all these terms. So here you see this is SBI in, sorry. So if you see this is the symbol, and ISIN number is international symbol. So all the stocks that are traded across the world, they get unique ISIN number or ISIN code. Then, so this is part of Nifty Bank. So you can think about this. Now here so here you can see this is basically your SBI instrument, and here you can see additional details. And we are more interested here. Why? Because if you look face value, so there are certain terms whenever we talk about face value. This is basically just a nominal value or some kind of value we put whenever bonds are used or whenever bonds are issued. So this is, we call it face value, and this is used for whenever certain payments are involved, payments. So we will see what kind of payment we are talking about. So issued, if you look at issued on 16th March 2011 up to 16th March 2016, it means for maturity is 15 years. And now next, your IP date is this. So basically, here we have looking at this, time date when we took this snapshot. So with that, all these informations are provided. Now this is the coupon rate. Remember, coupon rate, as I said, based on coupon rate and face value. So this is your 9.95 coupon rate, assuming if it is annually paid, means your bondholder get annual payment. So based on this coupon rate, so how much interest income or coupon payment interest income shareholder will get? Shareholder will get 9.9% of face value. So face value is how much? 1,000. So basically 9.95. So if you are holding one bond, so based on type of frequency, if payment is on annual basis, so on annual basis you will get 99.5 rupee as coupon income. Why? Because this is a debt instrument, and these are here you see payment is annual. So 99.95 INR you will get in every year from this instrument. So you think of, if you have 1,000 such instrument, so you will get, so your wealth will be 1,000 into 99.5. So this is going to be your income because of stated coupon in this particular instrument. So you think of a situation like, if you are evaluating, let's say if you are evaluating this bond, I'm assuming we are standing at 2011. Hypothetically, let's say we assume that if this bond is available, and whenever bond is going to be issued, all these information that we have seen here, issuer will have to make it public. So it means, and if you want to know how much wealth this bond will create for you in 2011, so you can basically calculate. How you can calculate? That 9.95% of coupon you will be getting every year. So we know that every year you will get, for each bond you will get 99.5 rupee. So this you will get up to 2016 2026. So these many cash flows you will have, and assuming that in 2011 your prevailing interest rate is 8%, means if you want to take, so this is a kind of opportunity cost, or this is why opportunity cost are, let's say, giving you 8% in 2011. So what we will assume that if I'm not depositing my money in the bank, but I'm buying this instrument, it means when you are going to discount it, 8% is going to be your reference expectation, or your expected required return. Means if you want to invest in this, you expect at least it should earn 8% of return. So if that is the case, using your present value annuity formula, if you remember. So 99.5 is the your amount. 1 minus 1 plus R is this, and it is issued for 15 years minus divided by 0.0 R. So basically this is going to be the present value of all 99.5 rupee that you are going to get. And at the end, remember face value is how much? Face value is 10,000. So also when it is, if it is maturing, you will also get this much amount at the end of 15th year or at the end in year 2016. It means if we do this, we should be able to calculate the present value of this bond. So again, to make it clean, here you see you have two type of inflow from this instrument. One is because of coupon payment, and second is because of your principal amount. So if I want to know what should be the present value, basically sometimes we also call intrinsic value. Remember, intrinsic value of this bond, it will be function of present value of your coupon payment plus present value of your principal amount. And coupon payment, already we have seen that your amount, basically your amount is nothing but your annual coupon. 1 minus 1 plus R, R is 8%, power N, here N is 15, plus your face value 1 plus R power N. So this is going to be your present value of this bond. So you can easily evaluate, this instrument. And also you can evaluate how much you are paying. If this present value is high than how much you are paying, then you can think of, investing in this kind of instrument. Otherwise, you may want to pick, other instrument. And assume, because this is also available for trading, using all these reference number, you can think of whether you should buy or you should sell if you are holding. So you can think, on this given date, September 17, 2020, bond was traded at 11,015 rupee. So now already know most of these concepts we have talked about. So coupon rate, basically coupon rate is the interest rate. Coupon rate, in this case, we are talking about this. Required rate of return is how much return investor is expecting from for their investment, like 8% we talked about required rate of return. And expected rate of return, many times expected rate of return and required rate of return both are assumed same. Why? Because investor, if they are having no heterogeneity among their expectation, then required rate of return and expected rate of return are going to be the same. And when we talk about realize means how much actually interest rate earned by the investor on a given instrument. So basically what we can only calculate realize looking at the historical data set. So these are certain terms are there, we use it. And now coming back to intrinsic value or present value. Already we said that, yeah.
Sir, what is the difference between realized interest rate and sir, expected rate of return?
Expected means you are assuming that on, let's say, expected means, let's say if you are investing for 10 years, right? And right now, if your benchmark is, let's say, bank, in bank interest rate is 7%. Hypothetically, we are assuming. Why 7%? Because this is what best available options. Let's say two options you are considering. One option whether to go and deposit your wealth in bank or going and buying one bond. Let's say this SBI bond. So when we are saying expected interest rate, basically expected interest rate take cares of about your future investment. Like, what could happen here in this time period. For example, you may argue that right now my second best investment option or alternative gives me 7%, which is basically bank is offering you 7%. So this is your required rate of return. But you also add that in future this interest rate may change. So there may be, with this, you may add some delta or you may subtract some delta based on your expectation about future. So in that way, your interest, your, expected rate of return will vary from required rate of return. So expected, when we are saying, it is basically on long time horizon and how much return you are going to get from your investment. And required rate of return is minimum return you should get to take an investment decision. And realize means what you are going to realize. Let's say after 5 years you purchase particular instrument and now you want to know how much return you have got. Then using the historical information that we calculate, we call it realized rate of return or realized return from your investment. So these are certain terms we use, and once you start using it, then you will be finding it easy to call and to define.
So what
Yeah.
is as soon as we buy a bond, let's say I buy a bond for SBI for 10 years, the coupon rate is fixed.
Coupon rate?
The coupon rate is fixed, right?
Yes, that's what I'm saying. Even at time of issue here, I'll go back. So this coupon was fixed here itself.
Then sir, what is plus delta and minus delta that you mentioned that this might be?
Plus delta means your expectation. Let's say you assume that in future interest rate will go up. So rather than using current 7% which is available in the bank, you say no, I want at least my required rate of return is, let's say, 7.5%. So based on your expectation, how you decide your required rate of return. In this case, if you remember, we assume that 8% is, let's say, is prevailing, interest you can earn on your bank deposit. So we assume that it is going to be same for entire period. Let's say this is going to be same for entire period. That's what we have assumed. But you think about a scenario where interest rate every year it is changing. So in that case, you may not want to have 8%. You may want to have 8% plus delta or minus delta. Delta means if you think interest rate will go up, so you should also get more return to compensate for your, because you are going to buy this instrument. Let's say you are buying this instrument in 2011 for 15 years. So if you are going to hold it for 15 years, so that of course you will do some kind of future analysis whether prevailing market interest rate will have upward trend or it may have downward trend or interest rate may go down. Right. And also, when we talk about investor may have, high risk, taking capacity or low risk taking capacity. And that will also, determine their required rate of return whenever, these investors go and buy certain instrument.
Yes, sir, I got it. Thank you.
Yeah. So it's, it's not very, there is no, very straight answer. Even in your, your case, some student, they expect that, market is giving me 10%. Why I should stick with 8%? I'll discount my bond earning using 10%. So in that case, their present value will be lower because of a reverse relationship here. So this is how we can calculate, a bond or your present value of bond, and these are your coupon or cash flow we are calling, because cash flow is very general term, but this is basically your coupon income or income which is happening because of interest rate stated on your bond. So this is how, already we have talked about this. So here, one situation is there. So if you read this problem, so what this problem says, that a bond you purchased 2 years ago for 890 is not selling at. So basically this is your T is equal to 0. Because now means T is equal to, we are standing here. The bond paid rupee $100 per year in coupon interest on the last day of each year. You intend to hold the bond for 4 more years. Remember, for 4 more years, and project that you will be able to sell it at the end of 4th year at 960. So you think, this is a scenario where bond life is very long, and let's say here you purchase at $890. So this is T minus 2, and this is T is equal to 0, and here it is available at this price, and probably here after 4 years, so basically T is equal to 4, you can sell this at 960. So this is, hypothetical case, and why it is assumed, because your bond, let's say it was issued in T minus 10 years. So this is T minus 10, T minus, and here you have in between time period, this is T minus 2, this is T is equal to 0, and we are standing here. This is at present. So you also project that bond will continue to pay this in interest, given the risk associated with bond. Required rate of return is assumed 11.11 and a quarter %. So what should be the bond's true price or fair price? Why we are calling it fair price or true price? Because you know more or less what kind of cash inflow will be there. You know your expected return or required rate of return or your cost of capital, means there are various terms. You know every year for next 4 years, $100 is going to be your income because of stated coupon. And you also expect that you will be able to sell at 960. And here, when we calculate it, it comes 935.31. Now, think about situation at today in the market. So today you have this is available. This is being traded at 925. And when you calculate intrinsic value is high. This is higher than this. So it means your currently bond is undervalued. Why undervalued? Because its intrinsic value is high, means you are holding a high value asset, but right now its value is in the market is 925. So or another way of putting this, it means you should hold this particular instrument. Why? Because this is undervalued. Overvalue means overvalue instrument is an instrument where their intrinsic value or fair price is more than their fair price is less than market price, and undervalue means market price is less than true value. So this is how we define, and we always try to hold or buy undervalue instrument and sell overvalue instrument, because overvalue instrument is not going to add any further value to your portfolio. So this part is clear. So this is very simple application, but you can think of many difficult scenario where, let's say, rather than annual payment, this could be semi-annual. You think of that situation. We will take, already I have here. So tomorrow we'll discuss about, this is a very plain calculation, but think of every year you have twice payment. 2 times you are going to get your coupon, semi-annual coupon. Then how your results are going to change. So those kind of calculation we will discuss tomorrow. But what I expect, at least whatever we have covered today, you please go and read concept, especially if you are reading all these concepts first time. If you have done in your previous semester or through various sources, that's fine, but still you can go and revise it. But you should just go through concept related to bond. I think that would be very much helpful when we are going to continue our discussion in this topic. Fine. If you have any question, I'll take it. Otherwise, we will close today's session and meet tomorrow. Fine. So I believe there are no further questions. So thank you. So keep reading and let me know if you have any query. So we'll meet tomorrow. Thank you.